and Jayakumar, MD at Prime Securities, joining in our studios this morning. Jakes, good morning. Good to have you in the studios, and just so much news to talk about. Firstly, let's begin with Trump's tirade. This time around, a mirror tax in India. He threatens to slap one, and he's criticized India for high tariffs. Do you think this situation could escalate, or these are just tweets coming in?
At the end of the day, tweets, as we know, even...
I know he communicates via tweets, but yeah.
So I think, sometimes he gets up on the right side of the bed from our perspective, sometimes he doesn't. But I think these are passing days. My own assessment is, while the comment may mean something over a period of time, maybe there is some negotiating somewhere, that may start. But frankly, I think the sectors are too small. The total quantum, as somebody estimated, is about $5 billion of exports. And that to some tinkering on taxes on those, principally agri. At least from a listed space perspective, I think it's not there. Perhaps steel, in some sense, could be impacted. To my mind, that's the only sector, if at all. But right now, I don't think that's the case, even from a steel sector perspective. So I think we've got much bigger things to worry than Trump's tweets.
And those bigger things are elections, or is there anything bigger than that?
Well, I think elections was something to worry at least till about 8-10 days ago. My own feeling is that the way things have moved, public outcry, or not outcry actually, but public reactions to whatever has happened, notwithstanding whatever the minutiae are in terms of how many died, etc. I think the reality is that you've had a case of somebody who's landed on enemy camp and come back. If that's not a victory for diplomacy, what is it? We can keep arguing whichever way, but the sum and substance is that I think we have a very weak neighbor, which of course makes you worry also. Economically, I think they become extremely weak. Yeah. So my own assessment, very simplistically put, and I'm not a political commentator at all, is that I don't think we are anywhere close to war. Skirmishes will continue, but it's been heightened in a manner where I think I think there's clarity that will come through on the current elections as a result of public reactions being so positively towards the way we've handled it. And my own assessment is that the markets, in some sense, already suss out these things a little earlier. So I think a week, 10 days ago is when we made, I think, a pretty strong bottom for mid caps. And every dip in the market, index optically will probably keep testing 10.5, 10.6, but I think you'll have a bounce off that. So from an index standpoint, I'm not a great index believer because the index composition keeps changing and the broad market is much, much lower than these levels. I am extremely bullish on the mid-cap space, and I think you can't get a better time to stock pick. I mean, these are 3, 4, 5 years of this government, and we are back in an index, broad market index level to about 8,500. That's where you're getting a chance to pick up a lot of stocks. So market as a whole, very, very bullish. I think all the classic signs were there. Flows into mutual funds had tapered off. You had problems in terms of capitulation across the board, leverage in terms of mid-cap promoters, a lot of big groups in trouble when their stocks were getting busted. So I think you had the classic signs of a capitulation in the mid-cap space. On the frontline space, I have been of the opinion, including the last couple of times here, which means almost 6 months, that we are in this 10.4 to 11.2 range, and we pretty much stayed the course. For once, I believe now we are going to get past the 11,200 range. So I think we'll make new highs, and to my mind, even before the elections, on the index front, and we'll have huge value to pick up on the broad market front.
You're giving us just the sound bites we want for our promos right now, but
that's
no, yeah, you're talking about a lot of opportunity. You're very bullish, and you've always maintained that maintaining a stock-specific stance is the way to go. So within the mid-caps, there's so much opportunity. Where is it ideally that one can find value?
Unfortunately, we're on air and I don't talk stocks specifically, but I think if you look at sectorally, I think there are multiple sectors that are giving I think if you see, most sectors have stocks which have dropped 70-80%, and some of the frontliners for reasons which have been other than just the fact that business has suffered. And I think so if you look at it, I mean, I think pharma, to my mind, offers the greatest opportunity in terms of a big sector play, where even the large cap, there are 2 or 3 stocks which are in the generic space. And I think the generic space in the US has made at least a quarter or 2 quarters ago, in terms of price and in terms of the business potential, has made a fantastic bottom. So I think you have pricing power which can only go up, and 2, business prospects that are on the ascendant. So I think pharma as a large cap space offers great opportunities. From a small cap perspective, I think there is just a plethora of them. I mean, you look at industry leaders across, whether it's the home building, home financing, even the small NBFC, even in the NBFC space where stocks have got pummeled 70–80%. I think those which are, well capitalized, and there are many of them, they've come off from being, 4.5–5 times book to even 2–2.5 times. There's consolidation across the board that's happening, so that's offering a great opportunity in the NBFC space, where NBFCs have merged into banks, etc. Recently, there are 2 or 3 transactions. So I just think if I go down that thing, some steel companies, I think even in this gloom, offer some opportunities which, and the big ones are down 35–40% from peak levels. So I think there are opportunities across the board, and I for one believe that it's a great time to go back to the, drawing board, pick up the balance sheets, a document which people don't read very easily, and you're there. I think if I were to, Karl Marx had this thing, right? You have nothing to lose except your chains. Go out and sort of. So I think you have nothing to lose except your fixed deposit rate of interest. If that, this is the time to actually put on risk and get into the market in terms of hunting out mid caps.
Okay, you've touched upon a couple of very interesting points, and since you've talked about mid caps, let's come to that, because I think the first shake-off really came around with the NBFC crisis, now that you can call it in retrospect, around the IL&FS issue. So you believe that there is valuation comfort in the larger pool, and I'm not talking about the benchmark Bajaj Finserv, Bajaj Finances of the world, but again within the NBFC pool as well, where is it that you find that comfort? Are you willing to look at HFCs? Or is it still the...
I think HFCs is in fact the category where people find most comfort. I think the NBFCs that have been in the loan against share space or otherwise have been actually a little more hit because of markets, etc. And also this entire business about leverage which promoters have enjoyed, NCDs that they have issued to borrow against. Those have all come under a bit of cloud. But really speaking, I think if you look back and see the sectors that are growing, I think the MSME space still offers, to my mind, a well diversified risk portfolio. There are companies that are in niche spaces like education finance, which is actually growing. There are companies in spaces like consumer durables. Of course, the big ones are far too expensive still. They haven't really corrected. And of course, housing finance, while it's been a congested space, but there's been a lot of fallout. Number of names have dropped out, and the others are actually picking up the slack. But linked to this space is a lot of PSU banks have been picking up portfolios of these, and I think therefore the retailization of the PSU bank portfolios is happening amongst at least the top 2–3 PSU banks, and I think they will represent portfolio qualities very different from what they did a year and a half ago. So in the past we used to accuse them of being corporate focused, high on NPAs, kind of paralyzed balance sheet, not able to move. The same balance sheets have now got recapitalized. They've recognized losses, the NPA recognition has come off, and you got now retail portfolios that they're acquiring. I mean, this is the perfect storm, and they're still trading at 0.6, 0.7 times book. The only question mark on PSU banks is there a reasonable window of period where they don't need to continuously dilute? They are still capital short, so to that extent there could be dilution. But if you really look at it from an opportunity perspective, I think the top 2–3 PSU banks could give you 50% returns from here over the next 2 years.
And you're comfortable with the way they are stretching, SBI buying into Jet, etc.?
I don't think SBI has bought into Jet. All that they've done is, I think, in the interim taken a position where lenders have exercised their, let's say, free will to take control, and there'll be presumably further dilution that happens.
Of course, yeah.
When it does, their stake comes off and they'll sell and move on in life. I think it's a great proactive step in preventing the collapse, which, 5 or 6 years ago, we had in the case of Kingfisher. Now, a similar step may have prevented that from happening, but who's to go back? Equity markets teach you to look, you learn from the past, but, look ahead. So from that perspective, I think Jet's been a great story of how PSU banks have moved in, and pretty proactively at that. So, hats off to that.
Lender seat, the pilot seat, if you will, rather. Now, while you have maintained that economic growth is perceptibly slowing, you seem to have, veering toward the engineering space.
Sure.
That is intrinsically linked with overall economic activity, the macros, if you will. What really is driving the conviction?
I think what has happened over the last 2–3 decades is that engineering spaces have been the sort of ignored spaces in some senses, where capacities have remained broadly the same. People have been operating at 60-70% capacities. So the real economies of scale haven't kicked in. A lot of small companies, typically Japanese multinationals operating in India, Swiss multinationals operating in India, have very low floats. Therefore, they've been off the radar in some senses. They've had businesses that have been largely captive, and now for the first time they're expanding either in terms of small acquisitions or in terms of exports, and using this as a beachhead. Now with the rupee also weakening, and you're talking about rupee having moved at least 10-12% over a period of time, and most importantly, capacities are not available in the engineering space. So those capacities are now, they're operating at peak capacities, they're debottlenecking to increase capacity. So this is the classic case where EBITDA margins actually will explode, PE margins will go up as their top line moves, and I think you could have very good engineering. I mean, there are 4-5 names in this, and unfortunately our own the ethics on the thing doesn't allow us to speak stocks, but if you were to hunt deep enough, multinationals operating in India, I think there's a lot of opportunities there, especially in a space where the Indian, we've not been adding capacities, and now for the first time we're operating at full capacities. In addition to exports coming through, in addition to captive business being there, etc. So, to my mind, these are all perfect storms for value creation.
So you've said you continue to like chemicals. This is the most misunderstood space, right? Because I mean, each chemical company is different than the other.
Right.
What within chemicals interests you?
So here again, I'm saying this is a continuing theme. We had the first phase run up where simply people said China is preventing, polluting industries to operate, and therefore everybody moved. Now, as you've seen, many of these companies have corrected quite dramatically since, whether it's in terms of the industries which are steel related or chemical industries to be used for, as an intermediate for pharma, or, so chemicals are loose term. Essentially, it means polluting industries where the first phase cut down happened. Many of these companies went up and with the market have come off. I think it's time to relook at those, because the absence of polluting industries in China is not a transient theme. It is here to stay. And I think they're going to cut back even more severely. Next phase may well be in terms of a lot of steel related spaces which are polluting. There could be companies in the solar industry which could be benefited. So I think chemicals is loose. I mean, I agree that that's been a sort of a liberal use of that terminology, but the idea here is that the polluting theme hasn't gone away. And I think as you look at, greater call on China, US negotiations, one of the big themes that's going to be here to stay is the polluting aspect. And I think, their own contribution to the climate change and stuff like that. So I think this is one theme we should pursue with. I also think that power companies, the resolutions thereof, are leading to very, very interesting acquisitions that people are making. So those in the who have been in the power space or in the infra space and now acquiring some of these assets may actually end up with a very interesting portfolio. And I think a lot of power companies will get resolved as you go along in the next few months. And linked to that is the typical pre-election and post-election that the sort of the traversing that area could be the infra and road, where a lot of orders are sort of issued at this point in time. So I think you'll have a lot of activity on the road infrastructure space. There's been one recent, I think maybe a couple of days ago, this relaxation in terms of the REIT and InvIT issuances, where 49% become 70% in terms of portfolio coverage. I think that would benefit road companies immensely. So there are a few listed spaces which you could list, ones in the listed space that you could look at.
Okay, great. So steel, engineering, specifically exports, chemicals, select pharma, select NBFCs. That's where you believe the alpha generation is going to happen. But what about the good old private banks, and especially now the corporate banks, which just about everyone seems to be recommending and chasing? And autos, do you think there will be a big sectoral churn in the run-up to, again, the fresh highs which you believe are going to happen, is going to happen before the elections, and these sectors may take a back seat? Is there a sectoral churn which will happen?
Actually, when I said fresh highs, what I meant was that I think this 11,200 that hasn't been crossed. Of course, will be taken out. Whether we cross 11,600, I mean, I'm not sure. But I wouldn't be surprised if we saw a new high before the elections itself. So the point here about this is that what will make these new highs happen? I think PSU banks will be at the forefront. I think pharma could be at the forefront in terms of a sector. And the good old spaces that are well invested, I'm sure Reliance will play its role there, no question. In terms of the good old spaces that people have been invested in, when ultimately you need mutual funds and large FIs to hold these, right? So they continue to hold these. I don't think they offer great excitement, especially if multiple people have recommended.
They will not be the contributors.
And I think if multiple people are recommending those, to my mind, it's best avoided, because it's not often that multiple people recommend and multiple people make money. So, you know, that's going to be a normal sort of thing. I think the real alpha is going to be generated elsewhere. And we've, you know, dwelt on multiple spaces. So.
Okay, great to have you in the studios and great to get in such a positive view. Good,
Thank you.
Good speaking with you. Thanks.
All the best.
Okay, that's the word coming in from N. Jayakumar.